Well, let's get into market news today. Let's get into perspective on the outlook for emerging markets versus developed markets. We've got Colin McQueen, Senior Portfolio Manager at 4 Capital Partners, joining us from Cape Town. Colin, thank you so much for joining us today. So a lot that the markets are grappling with right now, but certainly as bottom-up investors right now, you're looking, scouring the globe right now, looking at where value is said to be had, and certainly looking at the equity environment on a day like today. We're seeing risk on the table. I suppose it is going to be a sense of what's the Fed going to do this week on a short-term basis. But give us your kind of view right now in terms of your mandate and your strategy, your approach to investing from a more longer-term perspective.
Okay, thank you very much, Samantha. Basically, for us, our investment strategy really is about trying to buy good companies when they're unloved and out of favor in the market. So we tend to be quite contrarian. We look for parts of the market that people are gloomy about, where that gloom may be overdone and we can pick up good companies on the cheap. And for us, really, the strategy at the moment is really bearing fruit from some of the hard work that we've put in over the last couple of years. If you think about the last couple of years, there's been a lot of gloom around, particularly about the economic outlook, and that's enabled us to pick up a lot of shares in markets like Europe and the US, which we're now seeing the gains from that come through as economies are strengthening. So for us, the immediate places where we're starting to see value, we're starting to see a little bit in the emerging markets. We haven't had big exposure to there so far, but as prices come back, we're starting to get a little bit more interested in those areas.
Well, just looking at emerging markets on a day like today, I mean, emerging markets sitting at a 3-month high, but it certainly has been a choppy and volatile time for them. If you're looking at projected earnings and what they're trading at, sitting at 10.6 times versus developed world as a whole sitting at 13.9 times. So sitting, of course, offering more value relative to the developed world. Where in the emerging market territories do you see an opportunity to get exposure, or is it more company specific?
For us, it's been more company specific. Really, obviously with the emerging markets, you can't ignore the macro environment. However, if you look at a lot of the discounts in terms of the price to earnings ratios for the emerging markets as a whole, a lot of that discount really comes back to property related companies and financials in China. And that's really the part of the market that we've remained very cautious about. We've had a very strong property market for a number of years. We've had credit expanding in China at 30 to 50%, and it's very rare that you see that expansion and it ends well for markets. So we're a little bit cautious about things exposed to the Chinese property market, but really other than that, it's being a lot of a case-by-case, stock-by-stock basis. We've particularly found value recently in Korea, with Samsung Electronics moving into the top 10 holdings for the portfolio. As Korea's been out of favor with investors, you've been able to buy shares in Samsung for only 6.5 times earnings. We've actually been buying what are called the preference shares in Samsung. Those are really non-voting shares in the company, and they get a 30% discount again. So we're buying into Samsung at only 5 times earnings, and to us that looks like a great opportunity. But that's really been the major focus. We've added to other areas in Asia as they've come back. Sorry, Samantha. No,
it was very interesting, views and very interesting, of course, perspectives there that you have on the Chinese economy, because just coming back from China, we certainly had a premier that was hoping to reassure the world and global investors around reforms and around the fact that they want to become more of an international player. But if you're looking at, your perspective right now, for example, in the property space, certainly does seem one to that erring on the side of caution. So what are your views right now on companies that have that large Chinese exposure? Do you look for that, given we know that overall there does seem to be a sense that China, although there's short-term blips, it is going to be an important global player, and certainly is right now?
I think that's right. I mean, China will continue to grow as a market. Our preference very much is where we can find exposure to the consumer side of the Chinese economy. We see consumer growth and consumer expenditure being very strong for a number of years. We're a little bit more cautious on some of the industrial and capital goods related areas in China. But for us, it's all about the price. If you pay the wrong valuation to buy into any growth area, you're going to get a poor return. And as we've seen China falling out of favor, we found one or two smaller companies in Hong Kong that have simply looked too cheap for us. We've bought a company called Prince Frog, which is the second largest manufacturer of children's shampoos and body washes after Johnson & Johnson. They've grown their core sales at 40% year over year. We've been buying that company at only 10, 11 times earnings, which looks like a bargain. So we're thinking some of those opportunities are appearing, but we still need to be selective because the credit boom that's been going on in China we think is very much nearing its end. So we have to be critically careful that we don't fall into the trap of buying property exposure just because it's the share prices have fallen.
And certainly it was, the Premier talking about in China around the efficient allocation of government finances to areas where there is going to be sustainable growth. One area that you're investing in the global arena is in shipping. This through Navios Maritime. And just before we go, tell us about the investment case that you see in this company specifically. And I can see that you're battling there with your earpiece, but tell us more about Navios Maritime and that investment.
Okay, I'll try and hold the earpiece together for you as well. Basically, for us, shipping isn't an area that we've traditionally invested in much for the fund. The shipping industry has suffered a lot of overcapacity. The prices for shipping routes and to build new construction have collapsed. And so a lot of people that were ordering ships 3 or 4 years ago are in a lot of financial trouble. Why we find the interest in Navios is Navios is one of the few companies that have got themselves into a position to be able to take advantage of the distress that's out there. They have solid equity finance and they have access to credit. They have access to being able to buy into distressed portfolios. So they've been building a shipping portfolio very aggressively. They've been buying from people that ordered ships at $50 million for a new constructed ship and buying them out at only 30 a couple of years later. So really we think to us it looks like a company that's in the right place at the right time. It's being able to take advantage of some of the dislocation that we've seen in the rest of the market. And clearly as China continues to grow, as world trade continues to grow, that excess capacity is going to get slowly absorbed in shipping. And we found these guys will have bought themselves basically a brand new fleet at 2/3 of the going market rate.